Hi, welcome to the Market Alert for Wednesday, the 18th of September 2019. Okay, so yesterday we had a watershed moment when the repo market collapsed in one of the worst things that can happen to this market. So let's just have a look at this in a bit of detail on why it's important just to get a grip of what actually happened yesterday. 53 billion in QE light. Fed concludes first repo in a decade. That's important to start with, amid liquidity panic. So basically, they had a few technical issues, but they needed to print 53 billion to keep the banking system afloat yesterday. Had a few technical difficulties. It was cancelled, and then 30 minutes later, it was up and running again. Now, there was a bit that I wanted to, it's here. While the Fed did not disclose how many banks participated in the operation, it is safe to say it was a sizable number. Worst result from Monday's unexpected repo operation, we can now conclude that an additional 1.3 trillion in excess reserves, a Fed which is now cutting rates by 25 basis points tomorrow. The US financial system somehow found itself with a liquidity shortfall of 53 billion that almost paralyzed the interbank funding market. So let's keep an eye on this. This is the first time in 10 years. I've always said that the banking crisis was never cured, and for years also spoken about keeping the markets on the highs, which is they did with great aplomb yesterday, as we will see now as we go to the Dow. We'll start off with the daily chart. The market managing to move back yesterday. Treading water, waiting for today's major news announcement, which is due out at 7 p.m. BST. You'll see there dropping the rates from 2.25% to 2% is what's forecast, and most likely to happen. If it doesn't, then you'll be seeing the market do this over the next few days. So yesterday, treading water, with all of what was going on in the background, it is pretty incredible that the market did what it did. So no doubt it was assisted by the plunge protection team. However, at the start of the session was very, very similar to what we saw in Monday's trading session as well. So you can see how the market was stuck in that sideways battle, up and down for the first part of the session, and then eventually broke to the 200 bar moving average, where the market then pulled back. You can see prices pulling back there. It's more than, or rather less than 76% retracement, but measured, if that was measured from the low here, if I measure from here to here, you will see that we're down by the psychological level. However, if we come off the support with the psychological level to here, you'll see we're bang on 62% retracement, and there we have the buy signal. One other thing that I've noticed as well over the last few weeks and started to implement is to actually increase the scalp level as well to 40. Normally we have it at 20. The rules still apply though. If the market trades up to 20 points, move the stop to break even towards the entry price, cancel the initial stop, and then you can either take the profits at the 40 or wait and see if the market comes back and moves higher, and use the fib retracements in order to measure that, along with the 200 bar moving average prices staying obviously above this as they retraced. And then towards the end of the session, which is why, again, no surprise, same pattern that we've seen for many years, we see the market also trade back to the upside, assisted no doubt by the plunge protection team there. So an interesting day for the Dow, and given the backdrop of the repo problem, incredible, miraculous in fact, to say the least. I just don't know how these markets manage to do it unless they're being rigged, and that appears to be the case. Meanwhile, in the pound, yesterday we saw the start of Never thought I'd actually be talking about the Supreme Court and its relationship to the pound. It seems slightly surreal, to be honest, but the pound, as I said yesterday, would be waiting for the court case, the appellant Gina Miller versus Boris Johnson, or the government, Boris Johnson in this case, on whether he lied about proroguing Parliament. And looking at this and having read a bit about it, it looks like the Miller case was well received by the market yesterday, with prices moving higher, no doubt also influenced by the fact that the dollar was moving lower. But at the moment, the pound's focus is going to be on this case, of which they will have a verdict on Thursday, apparently. However, things not so rosy here to start off with. You see here that the market traded down, filling the trade, but the eagle-eyed amongst you, if you have a look at this, you can see how the market came back down to the entry price here. We've got this double bottom in place. We've got the psychological level here as well. And also, what's fascinating here, if you want to get into a trade after the market's failed with a automatic signal, you'll see the market traded down to this low, traded to 76% retracement here. It double bottomed here, and then prices, let's remove these just to make it a bit easier to see. The market then moved up, and then it retraced again back to the psychological level. And the key here is this: from this low to this high, the market trades towards the 76% retracement. The first sign of any potential strength coming into the market with regards moving averages is that prices will close above the 20 bar. They will close above the 50 bar before the 50 bar crosses or the 20 bar crosses the 50. We'll trade up to the 200 bar moving average, also the DP. Market trades through this and then runs to the upside. So even though there was a losing trade here, for those that did dip their toe in the market yesterday, and of course I did advise about it being fairly quiet, not saying that it wasn't tradable, but you've got to be careful that you can get stuck and sit and watch paint dry all day. That's the only problem, especially with something as big as what's going on at the moment. However, if you are sat in front of the computer, you can see these patterns showing themselves as they unfold, and then prices moving up at 97 points before being taken out of this potential trade. 97 pips, I should say. Meanwhile, in Bitcoin, this was a bit more lively yesterday. Prices picking up a bit, extending the range, but very choppy, as you can see here, for this market. In fact, let me just reload this chart. I can see there's a couple of gaps over here. So something's not right. Let's just reload this. Right, that's better. It's all sorted out on this side now. So yeah, yesterday you can see that in the 15 minutes, the market finding support with these spikes, but very choppy once again, and a narrow range. Market trading up to the 200 bar moving average, trading back. And again, you see them buying back in. What I do love about this market is you can spot with the volume exactly what's going on. I mean, it's just plain to see how they're supporting the markets, and then combined with everything else, the retracements, 200 bar moving average, pivot points and averages, it's easy to formulate a trading plan there. Meanwhile, in the 4-hour chart, Bitcoin managing at the moment, only at the moment, to trade back above the 4-hour. But you can see how sideways this market's become over the last few days there, really sideways. And this is incredibly clear in the daily chart there. So again, my advice at the moment, until we get a bit of a breakout in this one, and a bit more smoothness in prices that we saw from the run all the way up from December, then I would sort of stand aside there. Okay, let's have a look at the last few points. We've got implied volatility. This increasing slightly yesterday. Surprised it's only by this nominal amount that we can see here. Obviously waiting for today's FOMC, and again you can see they're moving back up slightly. Not looked at Deutsche Bank for a while. You can see here that this is moving back towards the 200 bar moving average. Get rid of all of this lot. There we go. You can see they're back below the 20 bar moving average, and yeah, but not a lot to report there. Other thing is we've got the 10-year updated as well. Let me just get that for you. So the 10-year yield, you can see it's been moving to the upside until this is Monday. You can see just coming back there, a bit of a problem with the bonds rallying once more and the yield moving lower, but certainly indicating recession down the line. Okay, that will do for this one. Let's wait and see what happens this evening, and keep an eye on the pound during today as well if you are sitting at the desk. See how things pan out as it takes on board what happens in the Supreme Court. Okay, that will do it for this one. Watch 7 PM tonight. And as ever, thanks for watching. See you in the next.